A market with one of the largest supplies in crypto should not behave like a scarce asset. And yet, that is exactly what XRP has been doing. If abundance is supposed to suppress value, then why does the market keep reacting as if something is quietly running out? Most investors believe they understand supply. They look at a number, compare it to Bitcoin, and draw a simple conclusion. More coins means less scarcity. Less scarcity means less upside. But what if that entire framework is flawed? What if the number everyone is watching is the least important number in the system? Because beneath the surface, something doesn't add up. Liquidity behaves differently. Price reactions don't align with expectations. And the participants who move the most capital are not behaving the way retail models predict. This is where the contradiction begins to reveal itself. What appears to be an oversupplied asset may, in practice, be operating under tightening conditions. Not suddenly, not visibly, but steadily. And if that's true, then the real story isn't about how much XRP exists. It's about how much of it actually matters. The confusion begins with a single number, 100 billion. For most market participants, that figure defines XRP entirely. It becomes the anchor for every assumption that follows. High supply, low scarcity, limited upside. A simple equation that feels logical and yet leads to consistently flawed conclusions. This is where the majority gets trapped. They take a framework designed for Bitcoin and apply it directly to XRP, as if both assets operate under the same rules. Bitcoin's narrative is built on fixed supply and predictable issuance. Scarcity is transparent, mechanical, and easy to model. XRP does not function that way. And this is not a minor difference. It is a structural one. Because when investors focus only on total supply, they ignore how that supply behaves. They assume availability where there may be none. They assume liquidity where it may already be constrained. What matters is not how much exists, but how much can actually move. And this is where the surface level analysis begins to break down. Because the supply you see is not the supply that trades. And the part most investors rely on may already be spoken for. To understand what is actually happening, the focus has to shift from supply to liquidity. Not theoretical supply, but usable supply. The portion that can move freely, settle transactions, and absorb demand without friction, because in practice, these are not the same thing. A significant share of XRP is locked in escrow, released on a predefined schedule. On paper, this looks like constant inflation, a steady increase in available tokens entering the market. But that interpretation misses the mechanism entirely. Escrow does not represent uncontrolled supply expansion. It represents controlled distribution, predictable, measured, and largely pre-allocated in a way that limits sudden shocks. And then there is the second layer, which is far less visible. Long-term holders, participants who accumulate XRP and remove it from active circulation, not for days or weeks, but for extended time horizons. Their behavior does not register in daily volume. It does not create headlines, but it steadily reduces what is actually available. So while the total supply remains constant, the usable supply begins to tighten. Quietly, gradually, almost invisibly. But that is only part of the picture. Because beneath this controlled structure, another force is beginning to shape how much XRP is truly accessible. And this is where the dynamic shifts from passive holding to active demand. This is where the behavior of institutions begins to matter. Not as headlines, but as patterns. When firms like BlackRock and Franklin Templeton step into digital assets, they are not entering with the mindset of retail participants. They are not chasing volatility. They are positioning around infrastructure. And infrastructure requires reliability. It requires access to liquidity at scale, not occasionally, but continuously. This is what separates speculation from utility. Because if XRP is used as a bridge asset in cross-border transactions, then its role changes entirely. It is no longer just something to hold or trade. It becomes something to source, to move, and to deploy efficiently within financial systems. And that introduces a different kind of demand. Not emotional demand, not cyclical demand, but operational demand. The kind that does not disappear during consolidation phases. The kind that does not wait for market sentiment to improve. This is where it becomes interesting. Because institutions do not need XRP to go up in price to justify involvement. They need it to function. And when an asset is required for function, it begins to be treated differently, allocated differently, removed from speculative circulation. So the question is no longer how much XRP exists. It is how much remains available once usage begins to scale. But the market doesn't operate in a vacuum. It operates under uncertainty. And in XRP's case, that uncertainty has been shaped largely by one force: regulation. The involvement of the US Securities and Exchange Commission introduced a layer of hesitation that few other assets have experienced at this scale. For years, this uncertainty has acted as a ceiling on sentiment, keeping retail participation cautious and, at times, disengaged. At the surface level, this looks like weakness, but that interpretation assumes all participants react the same way. They don't. Because while uncertainty discourages speculation, it does not necessarily prevent positioning. In many cases, it delays visibility. It creates an environment where accumulation can occur without attracting widespread attention, and this is where timing becomes asymmetric. Regulatory clarity rarely arrives at the beginning of a move. It tends to arrive after key positions have already been established. After the uncertainty discount has been absorbed by those willing to operate without confirmation. So, what appears to be stagnation may actually be preparation. What appears to be hesitation may be selective participation. And while the market waits for definitive answers, something quieter continues in the background. Positioning that does not require headlines. Positioning that does not announce itself. And by the time clarity becomes visible to everyone, the structural shift may already be well underway. This is where the idea of a supply shock needs to be redefined. Most investors imagine a sudden event, a sharp imbalance where demand overwhelms supply in a visible, explosive way. Price reacts instantly and the narrative forms after the fact. But that model assumes the market is reactive. In reality, structural shifts tend to build long before they are recognized. Because what is happening with XRP is not a sudden removal of supply. It is a gradual tightening of liquidity across multiple layers at once. Escrow controls the rate of distribution. Long-term holders remove tokens from circulation, and emerging utility begins to redirect available supply into operational channels. Individually, each factor appears manageable. Together, they create compression. This is not weakness, it is absorption. Periods of low volatility, sideways movement, and declining interest are often interpreted as a lack of demand. But in structurally evolving markets, they can signal something else entirely. A transfer of supply from weak hands to strong hands, from speculative participants to strategic ones. And this is where it becomes critical. Because a supply shock does not begin when supply disappears. It begins when demand accelerates against already constrained liquidity. By the time the imbalance becomes visible, the adjustment is no longer gradual, it becomes abrupt and difficult to respond to. So the conclusion is not as obvious as it first appears. The market continues to anchor itself to total supply, repeating a narrative that feels logical, but fails to capture what is actually changing beneath the surface. 100 billion remains the reference point, even as the conditions that give that number meaning continue to evolve. Because in reality, the constraint is no longer defined by how much XRP exists. It is defined by how much is accessible. And accessibility is being quietly reduced, not through dramatic events, but through structure, through behavior, through a gradual shift in how XRP is held, used, and integrated into broader financial systems. This is why the current phase feels uneventful to most participants. There is no obvious catalyst, no clear signal that confirms a transition is underway. Just time, movement without direction, and a growing sense of fatigue. But these are often the conditions where mispricing develops, where attention fades, but positioning continues, and where the majority, focused on what is visible, misses what is forming underneath. Patience becomes the separating factor. Not blind optimism, but informed conviction. The ability to recognize that not all supply is equal and not all demand is visible. Because by the time the shift becomes obvious, it is no longer early.